Everywhere you look, money is upside down. In a normal world, you lend your money and you earn interest. You save in a bank and they pay you for the privilege of using your deposits. That is how most people still think finance works. Work hard, set something aside, let time reward your caution. That is the story people were raised on. But for years now, in some of the largest economies on earth, the rules have quietly flipped. You lend to a government and you pay them. You put your savings in the bank, and instead of being rewarded, you are charged for it. Paying to lend, paying to save. It sounds like satire. It sounds like a glitch in a video game. Yet negative interest rates are not a typo. They are a deliberate policy choice. And, like every financial trick in history, they reveal something very uncomfortable about who really benefits from the system and who quietly foots the bill. On the surface, the explanation arrives wrapped in calm, technical language. Negative rates, you're told, are a tool. A clever way to stimulate growth, fight deflation, encourage lending, support employment, maintain price stability. Central bankers stand in front of microphones, surrounded by flags and logos, and speak as if this is just one more adjustment in a complex machine. Extraordinary, yes, but necessary. Temporary, under control. Behind that presentation is a much simpler reality. Negative rates are a tax on holding money, a penalty on caution, a punishment for saving. Strip away the jargon and the picture sharpens. A system drowning in debt, addicted to cheap money, terrified of what happens when borrowing becomes expensive again, has reached for one of the last levers it has left. Instead of rewarding prudence, it begins to quietly harvest it. To understand how strange this really is and how far from normal, it helps to go back to something basic, what interest used to mean. For thousands of years, interest was treated as the natural price of time and uncertainty. You give up money today, you do not know if you will get it back tomorrow. You demand compensation. In the clay tablets of Mesopotamia, in the ledgers of Greek merchants, in the contracts of medieval moneylenders, interest was simply how risk and time were priced. Religions often condemned usury. Philosophers argued over what was fair, but almost everyone understood the basic logic. If you lend, you earn. If you borrow, you pay. Even when interest rates were low, they were still positive. Time had value. Risk had a cost. There were occasional moments when inflation ran hotter than expected and savers lost money in real terms. But the nominal rate printed on the bond, the number quoted by the banker, stayed above zero. For most of financial history, the idea that the official declared rate would go below zero would have been considered absurd, a sign that markets were broken, that something fundamental had snapped. Then the modern era arrived with its crises, its rescues, and its fear of letting anything truly fail. After the global financial crisis of 2008 and the long aftershocks that followed, central banks around the world began an experiment. They cut interest rates towards zero. Then they hit zero. Then, in some places, they kept going. In parts of Europe, in Japan, in Switzerland, official policy rates slipped below zero. At the peak of this era, trillions of dollars worth of government bonds traded with negative yields. In plain language, that meant if someone bought those bonds and held them to maturity, the outcome was guaranteed. A loss, not a possible loss, not if inflation rises. A loss written into the contract from day one. Common sense asks a simple question: why would anyone accept that? Why would vast institutions, filled with professional investors and risk managers, line up to buy an asset that promises to return less than it costs? The answer reveals how deep the rabbit hole goes. Negative rates do not just appear by accident. They are engineered. And they only function if many large players agree to play along with a game that, on the surface, makes no sense. For those players, money is not just money. It is also regulation, collateral, and survival. Some institutions are required by law to hold what regulators define as safe assets. Pension funds, insurers, banks. Many of them must own government bonds regardless of the yield. The rules do not ask whether the return is generous, reasonable, or even positive. The rules only care that the asset is stamped with the word safe. So they buy not because they want to, but because they are compelled to. Other investors are trapped in a different way. They are so afraid of uncertainty that they are willing to accept a small, predictable loss in exchange for perceived safety. Losing a fraction of a percent each year buying bonds from a wealthy government may feel better than risking a sudden 30% loss in stocks or property if a crisis hits. When fear dominates, preserving 98 can look wiser than gambling for 100 and losing half. Then there is the invisible plumbing of the financial system itself. Government bonds are not just investments. They are also the raw material used as collateral for trillions in transactions between banks, funds, and corporations. If an institution needs collateral now, and the only bonds available have negative yields, it will still buy them. The small guaranteed loss becomes the cost of staying in the game. Put all of this together and something perverse comes into focus. People do not buy negative yielding debt because they enjoy losing money. They buy it because the system has been designed so that safety itself comes with a price tag. The direction of payment has flipped. The supposed safest borrower in the world is no longer paying to borrow from you. You are paying for the privilege of lending to them. On the other side of the ledger, the same inversion is happening to savings. For most of modern banking history, the deal was simple. Deposit money in a bank, and the bank uses it, lends it out, invests it, cycles it through the economy. In return, a share of the profit comes back to you in the form of interest. Sometimes generous, sometimes meager, but something. A reward, however small, for postponed consumption and for trusting an institution with your cash. Negative rates set that logic on fire. When central banks push their own rates below zero, commercial banks face an uncomfortable choice. They are penalized for holding excess reserves at the central bank. Their safest assets yield little or nothing. Margins shrink. They can accept lower profits and hope that volume, fees, and other lines of business keep them alive. Or they can pass the pain along. For ordinary customers, this shift is often disguised at first. The interest on savings drops to zero. Then account fees creep in, maintenance charges, minimum balance requirements, new tiers for premium accounts that used to be standard. What was once compensation for deposits morphs into a list of conditions you must meet just to avoid being charged. For larger depositors, the message is even more blunt. Very high balances, especially for businesses and institutions, may face explicit negative rates. In other words, the bank tells them, leaving money here will cost you. Do something with it. Invest, spend, merge, acquire, buy back your own shares, purchase something, anything. Just do not stand still. From the viewpoint of the central banks, this is the design. Negative rates are intended to make hoarding cash painful and borrowing easy. The hope is that this will jolt economies out of stagnation, raise spending, nudge inflation back to target levels, and keep employment high. But if you step back, a deeper pattern becomes visible. In a system addicted to debt-fueled growth, genuine saving becomes a problem. Caution is an obstacle. Prudence turns into something official. Policy discourages. Paying to save is not a bug in the program. It is a feature of a world where the survival of the system depends on keeping money constantly moving, constantly reaching for yield, constantly leaning into more risk and more leverage. This idea is not new. Governments have always searched for ways to reduce their debt burden without openly defaulting or raising taxes to obviously painful levels. One of the oldest strategies wears a polite name: financial repression. The recipe is simple. Keep nominal interest rates artificially low. Allow inflation to run higher than those rates. Make it difficult or impossible for savers to escape into alternatives. Over time, the real value of government debt erodes. So does the purchasing power of the savings sitting quietly in the banking system. Someone who looks at their statement sees a stable number: 10,000, 50,000, 100,000. The illusion of safety is maintained because the nominal amount has not changed. But in the real world, in grocery aisles and rent payments and utility bills, the value of that number is quietly shrinking. Debt is being reduced not by courageous budget cuts or visible taxes, but by stealth. Savers are drafted into a slow-motion bailout without ever signing a consent form. Negative nominal rates are simply the more extreme edge of the same idea. Instead of relying only on inflation to do the erosion quietly in the background, the system begins to charge directly for the act of holding money. The message, translated out of central bank language, is blunt. There will be no reward for sitting still. There will be a penalty. Every era justifies this in similar ways. It is for stability, for growth, for the greater good. The specific crisis changes. The rhetoric is updated. The costumes and logos evolve. But the effect through history is strikingly consistent. The debtor that matters most, usually the state and the largest borrowers surrounding it, gets relief. The cautious saver is squeezed. Once the price of money drops below zero, the damage is not confined to bank statements. Interest is supposed to be a signal. High rates say capital is scarce, risk is real, caution makes sense. Low rates say capital is plentiful, risk appears low, expansion looks attractive. Negative rates send a different message entirely. Debt is so cheap that almost any project can be made to look viable on paper. The future is discounted so aggressively that tomorrow starts to feel free. The result is a landscape filled with distortions. Companies that should have gone bankrupt years ago linger on cheap loans, neither growing nor dying, just existing as financial zombies that consume capital but produce little value. Asset prices drift higher and higher, not always because earnings or rents justify it, but because investors desperate for any positive yield are pushed into riskier and riskier corners of the market. Pensions and retirement funds, which once could rely on safe bonds to generate steady returns, are forced into more complex products, more leveraged strategies, more brittle structures, just to have a hope of meeting their promises. Safe returns do not disappear without consequences. When they are removed, people do not stop seeking returns. They simply go looking in darker alleys. On the surface, everything can appear calm. Stock indices reach records, real estate booms, borrowing remains cheap. Politicians point to rising markets as evidence of success. Underneath, fragility grows. The smallest rise in rates, the slightest shock to confidence, and the structure begins to wobble. There is also a quieter, more personal damage. Negative rates do not just break financial models, they break intuition. At its core, interest is about time. It is the mechanism by which the future rewards patience. Work today, save today, reap later. The idea that waiting is compensated is one of the moral assumptions baked into how people think about money. In a negative rate world, that assumption is reversed. Waiting costs. Holding back is punished. Caution produces a steady drip of losses. For a household trying to build a buffer, for a young person attempting to save, for an older person living on a fixed pool of capital, this inversion is not abstract. It shows up as disappointment, frustration, and eventually distrust. When saving no longer feels safe, when years of careful discipline earn nothing, when the only way to get ahead seems to be constant speculation, leverage, and a racing ahead of the next bubble, something in the social contract begins to erode. The belief that playing by the rules is rewarded fades. The feeling that the game is tilted hard toward those closest to the source of cheap money grows. So what survives in a world where saving is punished and lending can cost the lender? History offers a rough answer. Whenever official returns turn negative in real or nominal terms, whenever paper promises look increasingly questionable, value tends to migrate to places that do not depend entirely on central decisions about rates. Real assets, useful land, productive businesses, scarce resources, retain some claim on reality when financial abstractions wobble. Skills that generate value regardless of currency tricks become a form of wealth no policy can devalue overnight. Flexibility, the ability to move capital, to adapt, to step away from systems that no longer make sense, becomes more important than squeezing the last fraction of a percent from a savings account. Negative rates do not mean money is about to vanish. They are, however, a warning about what money has become under this regime. No longer a neutral unit of account or a stable store of value. Increasingly, a policy instrument shaped and reshaped to keep an over-leveraged system alive a little longer. When savings accounts yield nothing or less, when bonds with negative yields are still eagerly bought, when officials float the idea of going even further below zero, the pattern echoes many earlier periods. The many pay quietly through eroded savings, distorted incentives, and rising fragility. The few, closest to the levers, the biggest borrowers, the institutions shielded by too big to fail, are protected loudly. The story told to the public is familiar. This is temporary. This is necessary. There is no alternative. Yet history suggests there are always alternatives, just rarely ones proposed by the people running the current game. The alternatives come from those willing to see the pattern clearly, to recognize that paying to lend and paying to save is not a sign of a healthy system, but of one that has bent its own logic to the breaking point. Negative rates are more than a curiosity or a footnote in economic textbooks. They are a flashing indicator that the normal rules no longer sustain the structure built on top of them. They announce, in dull technical language, that ordinary prudence has been repurposed. Caution, once a virtue, has quietly been turned into a resource to be harvested. The desire to be responsible with money, to save, to hold back, to prepare, has, piece by piece, been transformed into the fuel that keeps someone else's debt machine running. In that sense, paying to lend and paying to save are not just descriptions of a bizarre moment in financial history. They are the clearest possible signal that the system no longer serves the story most people still believe about money, work, and reward. And whenever that gap grows too wide, history has shown that change eventually arrives. Not on the schedule of those in charge, and not always in the form anyone expects.